Hi, I'm Max Keiser. This is the Keiser Report. Payday loans, pawnbrokers, and the paranormal. Stacy Herbert?
Max, they're all connected in today's headlines. First, Bill Gross in a memo says, towards the paranormal. In this memo, he says, markets are slowly imploding because there's too much paper and too little trust.
Kill the paper bugs. Kill the paper bugs. Kill the paper bugs. All paper bugs must die!
Now, let's turn to the first stories here coming out of the UK. UK house prices stay resilient despite pressures. The average UK property is now worth 1% more than at the start of last year. It is a remarkable performance considering the crisis in the Eurozone. The average price of a home, Max, in the UK is now at £163,000, 822, whereas the average income for a working age household is £33,000.
Well, let's use the Titanic analogy, shall we? The economy hit the iceberg in 2007. There was a hole in the hull of the global economy. Now, to patch up the hole and to right the situation would require higher interest rates. But what we've seen around the world, Mervyn King in the UK, Ben Bernanke in the US, is to lower interest rates, which has the effect of widening the hole, thus speeding up the sinking of the ship, while the elite who are in these homes in the London area see the prices of their little escape boats go up. But the vast majority, the 99%, still stuck in the Titanic, are sinking fast and sinking even faster because lower interest rates are making the hole bigger. I presume it's because the people in the boats that are escaping from the sinking economy don't want anyone to survive, to live another day, and to go hunting after them.
Well, there is another explanation as well, because the average house price is now 5 times the average income. Payday loans. 1 in 7 Brits using credit to pay mortgage or rent. So nearly 7 million Brits are risking a spiral of debt by using credit cards, overdrafts, and payday loans to pay their rent or mortgage, a major housing charity has warned. Of those, almost 1 million have taken out high-interest payday loans to meet housing costs. And remember, Max, most people in Britain are only using interest-only mortgages as well. So they're taking out a payday loan to pay the interest on their mortgage.
Well, the stories are related. The rise in the house prices and multiples of earnings, that's due to the paper that's being created through low interest rates, and people are sailing away on their little escape boats, and a lot of those will sink as well. But it's all for the benefit of the few to survive. What you're saying here, 1 in 7 Brits using payday loans, again, more paper, as we see the transformation of Britain from a nation of shopkeepers to a nation of crack whores.
Well, the other thing is, as well, is that as we have always talked about, is that London is the center of global banking fraud. Martin Lewis of MoneySavingExpert.com says the UK is the crock of gold at the end of the rainbow for the world's payday lenders. They've been regulated out of other countries and jump for joy at our lax supervision. That's why these 4,000% APR lenders are exploding across British high streets. Yet these astronomical APRs aren't the real danger. That comes from the rollover. This is where people can't repay at the end of the month and compound interest kicks in.
Again, the paper flooding in to the economy and the UK as the nexus of global financial fraud because of the lax supervision and complete lack of regulation relating to hypothecation and rehypothecation. That's why MF Global had its headquarters of their major crime spree in the UK. Same thing with AIG. Same thing with Lehman Brothers. Same thing with Bernie Madoff. That's the iceberg that the global economy hit. And to let a few escape unscathed, they're making the hole wider with lower interest rates over there at the Bank of England or the Federal Reserve Bank or now the ECB. And it's benefiting less and less of the elite, the 1% of the 1%, in their escape boats. And they are happy to see the most of everyone else drown to death because they know that if they live to another day, they'll come after them with pitchforks and guillotines and this type of thing. But that's the dynamic.
So you have payday loans supporting this so-called miracle housing market in the UK. Now, as payday lenders are to the UK, you have pawnbrokers in the rest of Europe. Pawnbrokers feel Midas touch as Greeks slugged by taxes. Authorities have reported a boom in the pawn shop sector, with 90% of Greece's 224 officially registered pawn shops having opened in the past year. Many jewelers are joining in, putting placards in their window reading, "I buy gold." One Italian jewelry wholesaler, which has opened several franchises in Greece, accepts gold teeth in exchange for cash.
Right. Well, gold is the savior of the people being disenfranchised. Instead, because of the money flooding into the system that's bankrupted Greece and bankrupted the peripheral zone in the European nations, the Eurozone, they are now trading in the one thing that has value, gold, to get more of the very thing that is causing a loss of sovereignty, paper. And the paper bugs have to be destroyed at some level. And this is the theme for 2012, how to kill the paper bugs. And there are a lot of different initiatives. You know, Occupy Wall Street is one initiative. The global insurrection against banker occupation is another initiative. But these paper bugs must be exterminated.
Okay, so in the UK, we're told over and over by Cameron and by Mervyn King that at all costs they must sustain the housing bubble. And because of that, you see payday lenders. That's predatory lenders for the people. Here you have pawn shops exploding all over the place in Greece in order to sustain an unsustainable system, which is the Eurozone and the bailouts. Greece out of Euro if bailout fails. In order to avoid defaulting on a major bond redemption in March, we're told Greece must pass another austerity measures, more austerity measures, or it will crash out of the Eurozone unless it can agree to the terms of the 130 billion euro bailout.
Of course, but they will not be allowed to escape their current situation, the Greek people, because as long as they're being held down by the financial rapists, as I call them, or the paper bugs, and they're having their wealth confiscated and looted. They're having their gold sucked out of their teeth. They're going to give up the country's 111-ton gold position in the bank in Greece. They're going to be all of their assets, income-producing assets, the ports, the tourist attractions, anything that can throw off a nickel of income is going to be stolen and taken from the people. They would be benefited, of course, if they could get out of this prison, but they will not be allowed to get out of prison. No way. Of course, that's what should happen, but it won't happen because the Greek people are being gangbanged by the IMF, Christine Lagarde with a strap on, and all these other central bankers.
Well, let's see. There are some people escaping, Max, according to the next headline. Greeks, Italians moving cash out of banks. Greeks and Italians are taking their money and running, moving it abroad and even burying it underground for fear the Eurozone crisis will topple banks and wipe out what remains of their savings. So I think that's a bit of a lie there. They're saying that they're afraid that the Eurozone is going to collapse and wipe out their savings. I think it's just fear of bankers, that they're afraid of having their money stolen by bankers. We've already seen with the MF Global story that JP Morgan can go into any segregated account in the world, anywhere that they want, and just take it and, you know, hire a lawyer buddy, come get it from us.
Look what Jamie Dimon did to Muammar Gaddafi. I mean, look at the scene again. I mean, watching him getting murdered in the public on TV with Jamie in the background chuckling, ha ha, we took over your sovereign wealth fund with Goldman Sachs and bankrupted you. And this is what customers don't want to end up. They don't want to end up on the street being by some guy with a big broom handle because that they crossed paths with Jamie Dimon and Lloyd Blankfein. That's what people fear.
Actually, over the new year, I did read a little article where it hasn't got much attention, but apparently JP Morgan executive Tony Blair, who was good friends and suckered Gaddafi into this global scam, well, Gaddafi was so certain of his relationship that he apparently sent notice while they were being bombed. The only simple sentence, "What are you doing?" He wrote to Tony Blair's people, "What are you doing?"
Gaddafi doesn't know that the Mac Daddy is Tony Blair and JP Morgan. They're the terrorists.
speaking of banksters, big bank CEOs walk away with big bucks in 2011. So remember, at the end of the year, we covered the fact that bank shares were down hugely, up to 65%. Well, according to data from Rochdale securities analyst Dick Bove, the heads of major banking groups, including JP Morgan Chase, Goldman Sachs, and Bank of America, are out-earning their employees and shareholders, even as shares of bank stocks as a group lost about 26% in 2011. Take Bank of America CEO Brian Moynihan, who we talked about. Well, he's getting $2.26 million despite his shares falling by 60%. JP Morgan Chase CEO Jamie Dimon will earn $41.9 million, though his shares are down 23%.
Yeah, well, you take Mubarak out, you take Gaddafi out, you take the Syrian guy out, you have all that business to yourself. Accordingly. And people don't take him on because they don't want to end up like Gaddafi, what Jamie Dimon did to Gaddafi.
Press reports have suggested that compensation pools at 7 of the biggest U.S. banks will total about $156 billion this year, including salaries, benefits, and bonus, which would be 3.7% higher than last year's record-breaking number. So as you see, the economy continues to fall, and the paranormal that Bill Gross says, it's like paranormal that the bankers can continue to make money no matter what the market, up, down, disasters, collapsed, surging, no matter what, they continue to make more money.
Well, it's not paranormal, and Bill Gross should be ashamed of himself for resorting to such a thinly thought-out explanation for what's going on. My explanation, my analogy, is crystal clear. The Titanic is sinking. They're making the hole bigger by keeping rates low artificially, and this is benefiting a few people who are becoming fabulously rich. It's not paranormality. It's a designed way to impoverish the vast majority for the benefit of the very few. And that very few number of very few is getting fewer and fewer with each passing day. I mean, Bill Gross, his bond performance on his fund's performance is not great. So he resorts to rhetoric that is interesting to read, but it covers the fact that he doesn't really know what he's doing anymore. He's lost. Bill Gross is lost.
Well, he does say markets are imploding because there's too much paper and too little trust. And that would seem to be evident in the headlines we've covered.
Yeah, but his performance as a bond manager doesn't reflect his understanding of the inflation-deflation unwinding dynamic. So, Bill, watch this show, and your clients will be very happy that you did. All right, Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
All right, don't go away, much more coming your way, so stay right there. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Washington State and talk with silver guru extraordinaire, David Morgan of silver-investor.com. David Morgan, welcome back to the Keiser Report.
Max, it's great to be with you always.
All right, David Morgan, silver started the year with the biggest one-day surge in 3 years. Where do you see silver going this year?
Well, first of all, I'll tell you that, Max, and it's already in the public domain. But before I start, I just want to give the key word for all markets, especially silver, and that word for 2012 is volatility. We saw it, as you say, on the open here and got a better than 6% increase in one day on good volume. I see silver going somewhat sideways in a very broad, very volatile trading range for quite some time. I see silver basically doubling in the course of 2012. So specifically, I'm already on record as saying I see $60 silver prices by the end of 2012, and I think it may take as long as the whole year to get there.
All right. Silver and gold, of course, are both financial instruments, but they're also political footballs in the United States in particular. Candidates like Ron Paul, who are trying to bring back honest money and to get rid of the Federal Reserve, have made gold an issue. To what extent do you think gold prices and silver prices are, let's say, manipulated by those with a political agenda? David Morgan.
Oh, a great deal. You couldn't really put a percentage on it, but certainly gold especially, silver as well, are both managed. I like that word better than manipulated, but regardless, there's certainly powers in the markets with forces in the derivatives that can force the price down almost at will based upon a plethora of naked shorting, and that's taken place again and again and again. The long-term trend, however, cannot be manipulated. The long-term trend for gold and silver is still up. That's what you really need to focus on. Would silver prices be higher without them whacking down from the derivatives markets, and would gold be higher? Yes, they would be. But you got to look at that, I think, as an opportunity. And one question, Max, if I may, is that I get this constantly, and that is, well, if they can do this, then what's to prevent them from doing it, indefinitely or forever? Or why would I get in that market? And the answer is they cannot do it indefinitely. They're losing control. There is no way out of this situation. And because of the fact that a piece of paper does not equal a piece of gold, they're separate physical things, that fact will trump the market at some point. And it isn't an overnight affair, although it's possible that anomaly could occur. But the fact is, an ounce of physical metal is something unique, and it's very rare, and it's scarce, and it's precious. And because of those facts, you're going to find that somewhere, and it could be this year, there's going to be a parting of the ways. It's going to be the Red Sea again. You're going to find one set of gnashing and grinding of teeth of people that think that they own something because they have a certificate that says that silver's on it or gold's on it, and yet that's all they have is a certificate. So because more and more people are waking up to this because of the MF Global, the CME ruling, what's going on throughout the derivatives industry, which is totally beyond comprehension, you're going to find more and more people come to the physical side of the market.
All right, I wanted to ask you about Eric Sprott and what he's doing up there in Canada for a second, because he recently made an appeal to the silver industry, the silver mining industry, that they, if I get this correct, or you should correct me if I get this wrong, his idea was that for silver producers to retain earnings in silver or not pay out in silver. What exactly was he proposing, and what do you think of the idea?
Well, first of all, I like the idea, not to take anything away from Eric Sprott, but that was something that, I had, and I won't say I was the first one, and I wasn't, but I had proposed that very early on as the Natural Resources Conference in Chicago with Rob McEwen. Rob was the head of Gold Corp at the time. Gold Corp in the early days was holding back gold as an asset for Gold Corp shareholders. I said, this is phenomenal. People love it. And we need to do something like this on the silver side. So that idea has been around for some time. It was proposed at one of the early silver summits to one of the larger silver companies. It got in kind of an open floor debate that got a little bit heated, but I like the idea. One company actually had done it, Silver Standard had done it to a lesser degree. My friends at Endeavor Silver have kind of held back some of their third quarter earnings in silver, so you could call them retained earnings in metal. I'm not sure it will grab hold. I like the idea, though. The reason I don't think it'll grab hold is if you talk to most of the miners, they'll say this statement: we're miners. We're not commodity traders. We don't really know what the future price of silver is. We just go quarter to quarter to get our earnings, and that's what our business is. However, a lot of these same companies say, well, what can I do that's unique that will make our company stand out from all the others? Well, you just gave us the answer. Hold back the earnings in physical metal, and you will be, in my view, head and shoulders above the rest of the pack, and you'll probably get a huge premium on your share price.
So this is obviously an idea that is the complete opposite of what we just saw a few years ago, where companies like American Barrick, a big gold producer, was actually in the market selling short gold as a hedge, and they had a huge short position on their books, and this was contributing to price depreciation in the metal. So I guess if they're not going to do the retention of precious metals idea, at least they're moving away from shooting themselves in the foot by shorting by the precious metals. Agreed with that, David Morgan?
I couldn't have said it better, Max. You're spot on.
All right. Now, bond manager Bill Gross, the famous bond guru, he is to the bond market what you are to the silver market. He says that markets are slowly imploding because there's too much paper and too little trust. So this is kind of following up on what you're saying, David Morgan, but can you speak a little bit more about this?
Well, the bond market's really the key to the kingdom. I mean, there's so much more that we all have vested in the system. And what I mean by system is a global financial system, and it's all based on debt, and it's all based on the ability to pay that debt off at some point. It's impossible to do so. And because more and more people are recognizing that fact, a lot of people are waking up. So now you get into what I call the financial survival mode. And the financial survival mode is the realization of the truth that these debts cannot be paid. So you either default on the debt and say we can't pay it, take 50 cents on the dollar, or you default by printing the currency to the point where people won't accept it anymore. I think the latter route is the way it's going to go, although I don't rule out the former entirely. We get a downgrade in the United States one more notch. It's my understanding that there'll be a lot of money market fund managers that are required to dump the bond. Why? Because they have a certain criteria that's their mandate to hold a certain credit rating or above. If it goes below that rating, then they've got to sell it. So there's a lot of things out there in the bond market, and I don't talk about it often, but thanks for opening up the question, Max. It used to be one of my areas that I wouldn't say of expertise, but I spent a lot of time on. I don't anymore, but I know the fundamental facts, and those are the facts. And because of that, what's very scary of what could take place this year in the overall financial system based on the mistrust. Look, the insurance companies aren't buying them. The pension funds aren't buying them. Bill Gross dumped a great deal of U.S. treasuries. Nobody wants this stuff. So what's really happened is a short circuit. The short circuit is we got to sell these bonds. Well, the feds of the world are basically buying them, and that's printing the money. Yes, technically, America borrows $3,600,000,000 a day. I mean, that's basically, 10 days you bought up the entire silver supply. Regardless, it's a mess, and it's not getting better, and no one's offering any real solutions.
All right, now the reason we talk about silver is because looking back over the past 10 years, we see the top performing assets in the very top of that league table. You see oil did very, very well. Gold did even better than oil. But at the very top, number one performing asset over the past 10 years has been silver, with an 800% gain or so. Now, what we're looking at is that $50 price level, because that was the old Hunt Brothers high. We saw the price get just under $50 recently. Some would call that a double top. Some might say that it's just prelude for a bust through that magic, if you will, $50 level. From what I hear you're saying here today, David Morgan, you think that we're going to breach that level sometime in 2012.
Absolutely, I do. There's just not that much silver around. What is available is tightly held. Yes, there's been a huge increase in silver production in the last few years. I admit that. There's also been a huge increase in solar panel production. And if you go into we're going into a huge deflationary mode, silver is a self-correcting situation because 70% is base metal mining. So if you had a huge contraction in economic activity, that would curtail the base metal miners by quite a bit, and that would mean less silver production. So I really am still bullish. It's going to be, again, very volatile. But as more and more people wake up that there is no way out.
Okay, let me cut in there for a second. So in other words, when people say, oh, well, silver's an industrial metal, it's bearish in a decelerating economy, what you're saying is actually it's bullish because that means less mining of the base metals, which actually takes silver supply off the market. Meanwhile, there's still demand on the monetary side. But I want to talk about MF Global for a second and their crime spree. We've got a couple of minutes left. At the end of 2011, the trustees were talking about liquidating customer gold and silver positions. And there was a notion, actually, that the silver position on JP Morgan's balance sheet seemed to reflect to the ounce exactly what was taken out of MF Global's balance sheet. Your thoughts on the connection with the silver gold, MF Global collapse, and do you see any connection there with JP Morgan?
Well, I can't dispute it's very odd that those numbers line up. That's about all I'll say. I think you implied enough for people to think on their own. What I will add to that is that I'm remiss, and I don't mind being wrong, but it really upsets me. Because I've stated from the get-go that if you had a fully paid-for warehouse receipt or paying storage on your silver or gold, and it was one of the warehouses, which is really a bank approved by the CME, that you were safe. And that turns out not to be true. It looks like it's varying right now. I haven't seen the final ruling. It may be out, and I might have missed it. I just got back from vacation. But regardless, it's like 72%. So you've actually paid for metal. You bought it. You stored it. You've put all your fees into the storage costs, and yet you're only going to get 70% on the dollar. I mean, this is so bad. And that's another reason you're going to see more move into the physical realm. I've already talked to my broker. Some have left the industry. Accounts are dropping off. People just don't trust the system. It's breaking down in front of our eyes. And the one place you thought you were safe or should be safe also reneges on their promise on a partial basis. So, Max, this really upsets me. And I'll take a public apology to anybody that believed what I believed, that if you owned the physical metal and had a receipt backed by the CME, that you would be made whole, and apparently won't be.
All right, David Morgan of silver-investor.com. We're out of time. Thanks so much for being on the Keiser Report.
My pleasure, Max. Thank you.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest. The silver guru himself, David Morgan, is to the silver market what Bill Gross is to the bond market. He's literally the axe in the silver market, so follow his work closely. If you want to send me an email, send it to keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.